I'm Nicole Fragnito, PACNY's new executive director. I've been here for about 7 months, and I'm excited to get our first program underway. So those of you who are just joining us, thank you for taking the time today. For anyone who's not familiar with PACNY, we're the Preservation Association of Central New York. And as you'll see on the next slide, we are based in Syracuse, and we are the only preservation-focused nonprofit serving this region. We've recently celebrated our 50th anniversary and are looking forward to the next 50 years, beginning with programs like this one. This series was inspired by our success in getting the Westcott University Neighborhood Historic District added to the National Register of Historic Places. This accomplishment was a multi-year effort with our community partners and recognizes over 2,000 properties in the Westcott neighborhood. And as you'll hear today, being listed on the National Register opens up access to historic tax credits, which make restoring and maintaining these properties more financially viable. We're excited to have you with us and encourage you to join PACNY in our mission to revitalize and preserve the cultural heritage of Central New York. If you're not already a member or you need to renew your membership, please scan the QR code on the left to explore our membership options. As a 501c3 nonprofit, PACNY relies on the generous donations of our supporters. And if you find today's session helpful, please consider scanning the QR code on the right or visiting our website to help us continue offering programs like this one. We also invite you to our free annual meeting, which is being held on Sunday, March 30th. It will feature Dr. Sam Gruber, who will present on the architectural styles and history of the Westcott District. More details about that event are available on our website. So please follow us on social media and check your inboxes for upcoming announcements for more events and more historic tax credit sessions in this series. And before we get started, a few housekeeping items. We'll be having a Q&A session at the end where you can raise your hand and unmute yourself to ask questions, or you can use the chat to submit them. And I will be monitoring that throughout the presentation, and our presenters will be able to answer those questions. Our contact information will be available on the final slide, so feel free to reach out to us if you have more questions. This session is being recorded and will be made available afterward. So now let's dive in. I'm pleased to present our presenters, and they'll tell us a bit about themselves before guiding us through the world of historic tax credits.
Thanks, Nicole. Welcome, everybody. My name is Andrew Roblee. I am the current president of PACNY and also a preservation consultant. I'm going to be sharing a very brief history of preservation for those newcomers who maybe aren't familiar with it, and then talking a little bit about the ins and outs of the tax credit process. And I see that we have some experts watching, so now I'm nervous, but we should be, this is going to be a high-level view, so I can't make any mistakes. But before I go, I'd like to introduce Vasyl Khokla, who is going to share a little bit about the accounting and CPA side of the tax credits. So take it away, Vasyl.
Yeah, thank you for the opportunity to present a few tips about choosing CPA for historic preservation. So since historic preservation is very nuanced work, you cannot just work with any CPA because most CPAs specialize in tax preparation. And when you get into the implementation of the historic preservation credit, then special forms are necessary, and familiarity with these forms and how the credit works, how it's being spread out over 5 years, and how it can be possibly recaptured. All of that has bearing on the on choosing the CPA and making sure that a CPA has technical competence to help you specifically with the historic tax preservation project.
So Vasyl,
So,
just let me know when you want me to advance the slide, okay?
okay. Yeah, so the specialty the specialty of my CPA firms focuses on the sources of funds. So if you visualize accounting in terms of sources of funds and uses of funds, so when we talk about uses of funds, we can talk about expenses and assets. That's one side of accounting. Another side of accounting is sources of funds. So the question is like, where do businesses get capital? So there are five main ways to get capital. The first way is loans from lenders. The second one is investors and owners' capital. The third one is the business's own generated revenue. The fourth one is public-private partnership and government grants and tax credits. And the fifth one is funds from large corporations, grants from large corporations. So we'll focus today on that section for the funds from government as an incentive for individuals and businesses develop historic properties. Yeah, so you can advance the slide. So some of the points to consider with the historic preservation credits would be if that CPA has experience with those tax credits. So the questions you can ask the CPA is what familiarity do you have with the forms? What forms would be necessary to file? You can even ask what are the challenging moments you encountered while applying for these tax credits on the federal side and New York side? And what special programs do you know in the state? So for example, New York has a brownfield cleanup program. So that's a special program that New York State has. And then when we talk about some caveats, so one of them is that on the federal side, the credit is non-refundable, but on the state side, it's possibly refundable if the individual's income is not more than 60,000 per year. Then the second thing to look at is maximizing tax credit eligibility. So you can ask questions such as, what do you do to make sure that we are A, eligible to claim these expenses, and B, that we maximize the qualified rehabilitation expenses? So one of the issues is that sometimes people want to go and do historic preservation project, but they don't do it at a substantial enough level to qualify for the historic preservation. In order to qualify for that credit, the rehabilitation qualified rehabilitation expenses must exceed the adjusted basis of that building. So the adjusted basis is what you paid for that building minus depreciation. So the your rehab expenses must exceed the adjusted basis, because otherwise they won't qualify. And then you get into nuances such as like tangible expenses. And in New York State, it's limited to 24% of the costs. But say in New York City, the limit is lower. It's only 12% can go towards tangible expenses. So the third point is knowledge of relevant regulations. So it's been familiar how the computation for the historic preservation credit works both on the federal and state and for state purposes. And then there may be some local nuances too that will be useful to consider. And then like also changes in the laws. So for example, one of the recent changes in New York City is about the landmark zoning, about individual landmarks. So for a long time, there could be little utilization for the private partnerships and engagement with individual landmarks. But then the city, but then the city made them eligible for the investment by the private company. So it changes the market for individual landmarks in New York City. So it's like keeping up, making sure that the CPA keeps up with the recent legislation in the space. Then the final point is audit readiness and support. So in case when there is an audit, is making sure that your CPA saves sufficient corroboration of the qualified rehabilitation expenses, that everything is documented, that all the memos are written, so that in case the IRS or the New York Department of Taxation were to audit the credit, the CPA wouldn't be scrambling to find information. It will be all teed up. There will be some like substantially all of the work would be ready to submit with some tactical caveats responding to specific queries from the government. You can go to the next slide. So with the compliance reporting requirements, it's understanding the CPA's approach so that if you give a context of the specific property that you have in mind, is asking CPA, how would you approach it? Could you walk me through the steps, or how you will be ensuring the compliance for this specific property I have in mind, and how would you be going about maximizing the eligible expenses for the credit? And if your company doesn't have an immediate use of historic tax credits, then like selling them could be a viable strategy. But that would be, triggering, it will be, then we talk about IRS form 3468 and other relevant documents necessary. And usually you will need to work with the syndicate that has experience with reselling these credits to the entities that need those credits. So, like I work with one syndicate in Ohio. It's called GBX, but I'm sure like Andy is aware of some syndicates too that can, if in cases where your company cannot utilize the credits, then those credits can be resold to the entities that need them at a fraction per each dollar. So it can be 70 cents, 80 cents, depending on that specific case arrangement. Could you go to the next slide? Then some of the other factors to look at would be years of experience the CPA has, not in general, but specifically working with the historic preservation projects. And then like asking about client success stories that CPA can share, success stories, that the cases that he helped people with. And then success rate in, so you can ask in how many cases were audited, and were you able to do, what percentage of cases were you able to defend successfully? And then finally specialized training. So we already talked about making sure the CPA is competent specifically in the historic preservation space. Yeah, could you go to the next?
Thanks, Vasyl. So I'm going to, as I said, provide a very basic, very high level, broad strokes introduction to historic preservation and the tax credit. So if I don't go off script, it should be around 15 minutes, and then we'll take questions. So what most historic preservations will say if you ask them when the preservation movement got started, it would be the demolition of Penn Station in New York City in 1963. It's a very important moment in the development of our national movement. You can see Penn Station was a beautiful, monumental feat of architecture and engineering. It was designed by McKim, Mead, and White in 1910. But by the 1950s, the railroads were really falling victim to declining ridership as the automobile became popular. So heading into the 1960s, urban renewal programs were really at their high watermark all across the US, and New York City was no exception. As the economy was changing, the owners were looking to capitalize on a new structure to face that changing economy, and so they decided that they were going to demolish the station. And this galvanized a lot of local support. There was a public outcry, but it was too little too late, and Penn Station was torn down to make room for Madison Square Garden. After the loss of Penn Station, preservation took some leaps forward. The New York City Landmarks Commission was formed in 1965. And the following year, President Lyndon Johnson is seen here signing the National Historic Preservation Act of 1966, which established the National Register of Historic Places and a set of regulations for historic properties that continues to grow and evolve. So, I did want to talk briefly about the economics of historic preservation. I'm by no means an expert, but there are some advantages that can be demonstrated to adaptive reuse over new buildings. So there have been a number of studies conducted over the years by places like the National Trust, the Department of Commerce, the Department of the Interior, that show certain patterns emerge under most conditions. One of the most interesting patterns, it's not on the slide, but if you're raising an existing building with a Z, so demolishing an existing building, if that's required for your new construction project, then there is a demonstrable cost savings to adaptive reuse over doing that. And according to some of those studies from the National Trust and the Department of Commerce, those savings can range from 3 to 16% savings of adaptive reuse over new buildings. I did want to also share this slide from the AIA chapter in Connecticut, which breaks it down into the cost of square feet for these different property types. And so these are the stats for projects happening without the advantages of the wide array of financial incentives for historic preservation, which, as you might have already guessed, involve tax credits, which is why we're here. And that makes it all the more feasible to do these projects. So the National Park Service, which is the federal steward of the program, puts out a report every year that showcases the economic impact of the historic rehabilitation tax credit at the federal level. This is the most recent report from 2023. It shows the impact of the program that it's had since 1977. So we see well over $100 billion in investment that's been generated as part of this program. It's created hundreds of thousands of housing units across the country. And there's hard metrics and data that support adaptive reuse and historic preservation as the best approach. And this is only for the commercial tax credit at the federal level. It doesn't take into account the state level and the impact that it has closer to home. So let's get into it. Here's a screenshot of some information on a frequently asked questions page, which is available from New York State Historic Preservation Office, AKA SHPO. So if you hear us say SHPO, or if you call a consultant and they say SHPO, what they're saying is SHPO, State Historic Preservation Office. And they are the gateway for getting your property nominated, going through the tax credit project, anything to do with this official historic preservation stuff. So the slide really describes what the program is and what the eligibility requirements are. As you can see, owners of historic income producing properties are eligible for the federal and state income tax credits, and you can get 20% to 50% of your qualified rehabilitation costs reimbursed in those tax credits. The eligibility requirements are few, but they are important. Excuse me. The federal credit is available statewide. Well, first, you have to be an income-producing property. You must be listed or in the process of being listed. So you can begin the listing process at the beginning of your application process. So the federal credit is available statewide. There's a 20% credit at the federal level. And then at the state level, there's also a 20% credit, but that goes up to 30% if your project meets is under a certain scale. And I think it's $2.5 million. However, in order to qualify for the state tax credit, your property has to be located in a qualifying census tract, which we'll talk about. Vasyl mentioned the adjusted basis rule. You have to follow the Secretary of the Interior standards, and we're going to get into a little bit more detail with all these points of eligibility. The first thing I want to talk about is what is a QRE, or a qualified rehabilitation expense. So you've already heard Vasyl and I mention that, and what that refers to are the items that are defined by the IRS as eligible for the tax credit. The basic rule is anything, if you were to take the roof off of your commercial building and turn it upside down, anything that didn't fall out is generally covered as a QRE, and that's very wide ranging. As you can see, this list, this comes directly from the IRS regs. All these things are typically covered as QREs. So it's very wide ranging and provides a lot of coverage. If you're really curious about what is and is not covered, you can visit the IRS website, and they have this full list of what is and is not generally eligible. A qualifying census tract. So a qualifying census tract is defined by New York as a census tract where at least 50% of the households have incomes below 6% of what they call the area median gross income, or it has a poverty rate of at least 25%. So it's a measure of the poverty rate. And so for better or worse, almost all of PACNY's service area, that's Cayuga, Cortland, Madison, Onondaga, and Oswego County, are located in qualifying census tract. But there are a few exceptions. So in your wealthier areas around Skaneateles, you can see on this map, the gray areas to the south of Syracuse, those are not eligible. They're not qualifying census tracts. Everything in orange is eligible. So essentially, more or less, the entire city of Syracuse. An interesting little census tract is in red. It's around the Salt Springs neighborhood. This neighborhood qualifies for the homeowner credit, but not the commercial tax credit. So it's kind of an outlier. Generally, you will qualify or you won't. So let's move on. Secretary of the Interior standards. So you saw on the eligibility page that all the work you do to your building has to satisfy the Secretary of the Interior standards for rehabilitation. Obviously, since you're getting historic tax credits from the government, they want to make sure that you are doing historic work. However, these standards are meant to be flexible and allow for adaptive reuse. They're not interested in freezing the building in time, but they do want to make sure that sensitive changes are made to historic buildings for their current and future use. Okay, so let's get into a little bit of details for the commercial tax credit, and I'm just going to use an example. You're looking at the floor plan for an office building somewhere in upstate New York. It was built in 1929, and it has several upper floors which were built as speculative office space. So since 1929, much of the floor plan has been renovated once, twice, sometimes several times. But what is historic is the elevator lobby and the main corridor down the center. These have really great terrazzo floors, and that's where all the historic fabric still remains. So the purchaser and the developer of this building wanted to make these offices into apartments. There's a lot of office to residential conversions going on. So let me show you what they plan to do. Here's their plan, which was approved by SHPO and by the federal government for their tax credits. And they saved the historic corridor, the elevator bank, the elevator lobby, and the main corridor. But they had a lot of flexibility to rearrange the residentials, the former office to residential spaces. And so you can see that as long as you meet certain standards in the preservation of those historic elements, there still is plenty of flexibility. And I want to show you a specific example. So here is a room on the fifth floor, and this was as it was when the developer purchased the building. Now, the good thing about this program is a new owner is not necessarily going to be penalized for something a previous owner did. So there's a lot of work done on this floor. You can see it's got a modern doorway. Everything is drywall or a drop ceiling. This was all able to be demolished, and they turned it into a pretty nice residential unit. One of the stipulations was, because this was an office building, originally there were no drop ceilings, so everything had to be a hard ceiling, and all the mechanicals were hidden behind chases. Those are kind of the nitty-gritty details that you'll get into once you're dealing with your commercial tax credit project. So now we're going to move on to the historic homeowner tax credit. So New York State, aside from the federal government, also offers a historic homeowner tax credit. There is no federal homeowner tax credit, but since New York State is a leader in preservation, and as an aside, I'll tell you that New York by far has the most successful tax credit projects across the country. Since they are a leader, they have this homeowner tax credit. You are eligible if your house is listed on the National Register and is in an eligible census tract, which we discussed earlier. And if you meet those requirements, you can be eligible for a historic tax credit equal to 20% of your repair costs. There's a couple other qualifications, though. Your repairs must cost at least $5,000, and you have to spend at least 5% on the exterior. Given the cost of construction and materials these days, I don't know if that's a very hard measure to beat. So for better or worse, that's the way it is. One of the really important things that they mention on this slide, or on this image, that I want to stress is that all the work must be approved by SHPO before you begin your work. If you start working on the house and then you go to apply, you run the risk of paying for work that you can't get tax credits on. So bear that in mind. So we've talked about the areas in Syracuse that are in qualifying census tracts, but I want to just demonstrate on the southeast side of a few areas that are currently listed that would be eligible for the homeowner in the commercial tax credit project. Of course, recently the Westcott University Neighborhood Historic District, where there's at least 2,100 properties that are now eligible for these tax credits. PACNY is very proud of the work that we've done there, and we hope that more and more people will take advantage of those tax credits. We've said this before, but at the state review board meeting where they approved the initial state listing of this neighborhood historic district, they said that 80 tax credit applications had already been received by SHPO. So that's great. Other historic districts in Syracuse include the Holly Green Historic District, Onondaga Highlands, Swaniola Heights, Berkeley Park Subdivision, and there are others. You can go to the address here and use the state's map to zoom into Syracuse and see just where all the National Register listings are. And then there's one more tax credit, which may or may not apply to you, but I wanted to mention it. It's brand new. It's the New York State Historic Barn Rehabilitation Tax Credit. It's a state level tax incentive used to support the preservation of historic barns in New York. It provides a tax credit to the tune of 25% of your QREs, up to a maximum of $250. The barn must have originally been agricultural, although I will say that folks at SHPO have indicated that they could, given the right argument, approve carriage houses. And that's important because I know that there are a number of carriage houses in some of these, what are now urban districts. So that's important to know. And this tax credit was really set up to extend some of this economic incentive to the more rural areas. But like I said, there may be some flexibility there that's worth investigating. And so finally, if you want more information on the tax credit program, please visit parks.newyork.gov. There's a lot of information there, charts and materials you can download to review. You can also reach out to somebody at SHPO who would be more than happy to answer any of your questions. You can contact PACNY via email at pacny.com. We're here to answer any questions you have. And with that, I will pass it back to Nicole, who will act as the interlocutor for our question and answers.
We don't have any questions in our chat box, but everyone is welcome to raise their hand, unmute themselves, and ask our presenters any questions that you have.
This is Jamie Williams. I have one that I would throw out to anybody who thinks they have a reasonable response to it. Having worked on a number of commercial tax credit projects, they're obviously fairly large scopes and budgets. And as we get into the historic tax credit projects for residential, they can be much smaller, but you still need a CPA. What is a reasonable cost of rehabilitation for a project that will be worthwhile given the soft costs involved?
Wow, that's a really great question, Jamie. I think that, Vasyl, not to throw you under the bus, but I feel like that answer might require a more accounting-based mind to figure out what the cost analysis would need to be to make that worth it. Do you have any insight on that?
Yeah, so if we say, like, let's take an example. So if we take something to the effect, like we talk about 100,000 in qualified rehab expenses, so it's like 100,000, like, and if we talk about the credit, then we talk about 40,000 in tax credit, both for federal and state. So, if I were, like if I were to take on the project, I would want to see something like within 100K to it, because in that case, it makes more sense for the person who is restoring that property, and as Jamie mentioned, covering the soft costs and making it work. So like I would use something like 100K as a benchmark.
Thank you.
Okay, I see Sarah Wall-Bollinger has her hand up. Hi, Sarah.
Hi, how you doing?
Good.
So I have a question about the companies that would want the tax credit. If the property is owned by a not-for-profit and so they don't pay taxes anyway, are there investors who would want to put this money up and then secure the tax credit as a way to pay themselves back?
I know that happens. As far as specific companies, banks can typically syndicate tax credits. For example, Chase Bank is the syndicate for the project that I shared on screen, and Vasyl mentioned GRX. Was that?
No, it's called GBX. Yeah,
GBX.
the database in Ohio.
Yeah, so I would start with financial institutions like that. And as far as a nonprofit goes, Vasyl, correct me if I'm wrong, but that does happen where nonprofits can create a venue to capitalize on those tax credits, correct?
Right. So, what will need to happen is that the nonprofit signs off that building into the L for the for-profit LLC. So, like, but signing off that building into the for-profit LLC would need the approval of the nonprofit's board. So you will have to overcome those major obstacles to make sure that the board is okay with a deal like that. But as long as you can get the board to sign off on transferring the building ownership interest from nonprofit to the for-profit LLC, then it's a doable arrangement.
So yeah, so for example, this involved low income tax credits, but many years ago, I was involved with the Auburn Housing Authority Development Corporation. That was an LLC formed to basically act as a pass-through to collect tax credits so that the Auburn Housing Authority, which was a nonprofit organization, could benefit from the tax credits and do some rehab work to their housing units. So there are various ways to make that happen, but I would definitely get a hold of a CPA
Thank you.
to understand the rules. Yeah.
We have a couple of questions in the chat. The first is from Matthew Peters Warren, who asks, how challenging is it for homeowners to get projects approved, and how long does it take?
So the reason that you hire a consultant is that they understand the Secretary of the Interior standards, and they understand hopefully the reviewers and kind of the things that SHPO and MPS will approve. And so that's why you reach out to them, because they can help you essentially translate what your vision to what is most likely to be approved. So that's where you kind of divest yourself of the difficulty by hiring them. And there's many in our region. If you Google historic preservation consultants, New York, Central New York, you'll come up with folks. How long does it take? Well, I will say the review time for SHPO is set at 30 days. So every time you submit something, there's a 30-day review window. If you know, the other kind of parallel schedule with that is how long your planning and your construction is taking. So it's kind of, there's a lot of variables there, but in terms of the government, there's a 30-day review window for SHPO. If you're looking at a commercial tax credit project, you have the 30-day SHPO window, and then they push it to NPS, and they have a 30 to 45-day review window. And that's a timeline based on the staffing levels under the previous administration. So I'll put that asterisk on it.
And jumping off of that question in the chat, Georgia Popov also asks, does this program interface with home headquarters financing, and do homeowners need to provide quotes from contractors in the application?
No, you can utilize multiple sources of financing. So it's an additional source from that nonprofit organization to get loans. So it's perfectly fine to get funding through the loans and historic preservation credits. Yeah, and generally, yeah, it's a good idea to have a quote handy. So like once you have an idea of what the cost could look like, that way you could see, okay, first of all, does it exceed the adjusted basis, and then see if that credit would be worth your while.
In terms of the application, though, you do not need to submit bids because I believe that's because government approval of that bid, they don't want to be seen as endorsing any private business over another. But anyways, you don't need to submit your bids. I see Alex's hand is up. Go ahead, Alex.
Hi, can you hear me?
Yes, I can.
Okay, I'm a homeowner and I received some paperwork on this a couple of months ago. And in the commercial property section, it clearly stated that these tax credits can be used in combination with other federal and funding programs, but I didn't see anything for the homeowners side. And in the past, I've used a 30% high efficiency credit for things like insulation upgrades and windows that would count for this one as well. So would I be able to stack those, this 20% for homeowners and then like a 30% high efficiency credit?
I know the commercial tax credits definitely stack. People use the rehabilitation tax credit with like a low-income housing tax credit, so on and so forth. Vasyl, do you know any reason why the homeowner tax credit can't be stacked? I haven't run into that yet myself, but
Yeah, so you can claim both, but there is no double dipping. So I mean, if you're already using that cost as a part of your qualified rehab expenses, then you cannot use it also for the high energy for the energy efficiency credit. But as long as you don't double dip, you can use both.
Okay, thank you.
I saw also Sam Gruber had his hand raised. Go ahead, Sam.
Yeah, I just for the people who are homeowners, I know hearing about the commercial projects can be a little frightening because of the size and scope. But I mean, in our discussions with SHPO as we were putting the district together, we were assured that the process for relatively modest projects, say a porch, foundation repairs, even a new roof, could be done fairly efficiently and rapidly. And I do know some homeowners who've already put in paperwork in the district, and they they attest that they didn't have to put too many hours into the paperwork because they're working with their contractors from the get-go. So if the contractor specifies all of the work and photographs of the before and submits that, the SHPO people, they say they will work with the neighbors in the Westcott area um, to reply within the 30-day period about the appropriateness of the application. I myself have not done that. I am looking forward to doing a project on my own house, and what I'm trying to do is to bundle all of the possible repairs that I would need into a large project for efficiency's sake, and then to have all of that work submitted at the same time. What I don't know is if there's a limit to the construction period over which all the work has to be done, because lining up contractors to do work right now is a little difficult. But say if I had window work and siding work and steps work and interior work, all of which is included, um, I'm hoping to be able to submit all of that as one proposal, even if different contractors are doing the work, but and then qualifying. Um, the other question that we're asked here a lot is, I don't pay that much in state taxes, so how much am I actually going to, how do I get it? How much am I going to get back if I put $100,000 into a project? 20% is 20,000. I don't pay that much in state taxes. So how much is it worth it to me? What's the threshold to make it worth to me to do all the work for a project? So those are comments, but there's some questions in there. Maybe some of you who are more experienced, uh, can give some advice or opinion about how to proceed with that.
So I believe, yeah, we mentioned that the homeowner tax credit is refundable, which means if your tax burden is lower than the amount of credits you've amassed, you will be reimbursed for those. Isn't that right, Vasyl?
Yeah, so I must add that it's refundable only for the state piece. It's non-refundable for the federal, but for the state piece, yes. So it's like looking at your numbers. So as you mentioned, like very useful considerations. It's like, okay, this is my real like property tax, and this is what I'm gonna save on the project through the tax credits. Is it gonna worth my while? So you can do the calculation yourself, or you can ask like CPA to run the cost benefit analysis and help you understand if that is worth your while.
Yeah, we have a lot of people whose, some of the people whose properties need the most work are the people on the most restricted fixed income. So we have a elderly population who want to stay in their houses and would like to do the repairs. And up to this point, sometimes those repairs have seemed daunting and too expensive based on their budgets, which often include Social Security. So their question is this the time to do the repairs? And how much work will it be, but also how much savings will I get? And of course, the initial purpose for these tax credits when they were first instituted was more about making the difference between doing the right work for preservation versus the cheap work. But now the philosophy is more about maintaining a viable neighborhood. So a whole range of repairs that have nothing to do with the historic aspect of the properties are permitted, are actually encouraged. So if someone needs to redo their electric or needs to do their bathroom or their basement for different, I mean, many of these costs will be included. So it is the time to put together a bigger project. Um,
Sam?
so the question is, though, if they're on a fixed income, they're not paying much state taxes. So what will they get back? And they will get reimbursed, I understand, if they're below either a $50,000 or $60,000 income threshold, which some people are.
Yeah, I would say, every project's a little different. Please reach out to SHPO. They will help guide you on through these more fine details better than we can here. But I would encourage everybody to do that. So we have about 5 minutes left. Is there?
I just wanted to say that like one way to use the review, and that would be the ones out there who are more familiar with the credit can act as the initial filter. Then you can like refer the case to PACNY, who could see if the case is feasible, and if the PACNY believes it's feasible, they can ask his CPA like, hey, do you think we could claim the credit? So that way, we can filter it that way.
We're perfectly happy to take deeper looks at anybody's project if they want to reach out to us. That's what we want to be here for all of you. Okay, well, Nicole, I'm going to let you take us out. And thank you everybody for showing up today.
Yes, thank you. Thank you both for presenting, and thank you everyone for asking your questions. If you have additional questions or would like to reach out to our presenters, our contact information is on the slide. And in the chat, we've added some additional links of historic preservation resources and some information about PACNY. Again, thank you all for joining us, and please stay tuned for additional sessions in this historic tax credit series where we will provide more information about the process and hope to cover more of your questions. Thank you all. Have a great day.
Thanks a
Bye-bye.
lot.
Have a productive week.
All right, bye.